Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
Let's see what else we've got here. This is another example with the euro. As we said, this is the EUI. So the EUI over at the ISE is trading the U.S. dollar against the euro, and you can see that had several really nice trends on this one, especially when you add in %R along with the initial acceleration bands breakout. We got that first breakout all the way back in September of 2007 to the downside. So the dollar was really weak against the euro. You can see it then followed through below there, got our confirmation there 2 days later, and that was bear confirmed at that point. Part of the reason that I did adopt the %R as another kind of a retest method was that you see when we do get these retests, we're back into the acceleration bands. But that retest is actually on %R telling me don't panic. We're right back to the midpoint, which is the 20-day simple moving average. But notice how even when we're within these bands, look at all these retest points where we're getting a bounce, but it's not following through. It's not getting above there. So we're getting all these great points to keep tightening our stop only at those what I call inflection bars where you're getting those retest points. When this finally will end, you can see it's going to come in right here. It's going to break that. We got to get out now back at the end of November. So from that perspective, now we're kind of in a no man's land for a while. And then you can see we finally get going again. And notice when we don't get confirmation, when you try to break out, but you're right into the bands and it's not going through that high, the confirmation saves you from a fake out signal. So for me, missing fake outs is just as important as riding breakouts because it won't erode your confidence. And that's really something we have to protect. It's not just our financial capital, but also our psychological and emotional capital. This next setup that happens here, we're just trying to break the accelerations. Then we also break the Bollinger, and we're bear confirmed. And then you can see we were having a bearish retest also on EUI right here. And actually, right as I had updated this chart back in March, the last time I did this with Steve, basically we had a break right above that right there in March. And that was also a good move to get out of that because EUI, if you were to update that chart, we would see that basically from March, we actually had a snap up, then it bounced down, then it basically kind of it retested these lows, but then it ground sideways, and that's what we've been seeing actually. EUI just started to break out today, and we're kind of in what we'd call a setup mode where it's finally back up. Right now, today's close, it was 64.71. So you can see from where we were as of March, we've gone nowhere so far. Now that's great for spread strategies. And you'll see when we look at sideways periods, if you're looking at a period like this, do you want to, like in December and January, or do you want to be buying options or selling options when you're in that kind of in between the bands mode? You want to be more of a seller of options when you're not getting that kind of confirmation. So from this perspective, that really helps us to say, okay, let's look at this across whatever time frame we want to trade. We get a question in from Leonard saying, does this also work on weekly charts? Absolutely. I mean, it can work on any time frame chart. Another thing that's important to remember is what type of a percentage loss you're looking to take out your option if it's not working. Now, one of the rules of thumb we have is if we're putting on trades right into those retest points I was showing you, it's an ideal spot for what I call low-risk entry, that if we're wrong, we're going to be wrong quickly, and then we're going to get out. But typically with options, we find that somewhere in between this 20 and 33% threshold is about where the break point is for most option trades. So greater than about 30 to 33%, and it's starting to really slip away from you. Why is that so important? It's not just some random thing that I'm picking out, but it's the compounding effect. You know the power of compounding when it's working for you, but this is the power of compounding if you let it work against you too long when you buy an option and it's not working. You better have a way out of the trade. Stop losses can really save your hide. And so from my perspective, we tend to advocate, okay, if it breaks that 33% stop loss level, especially on an in-the-money option, it's just not working. And look at the gap that you've got to make up here. If we were taking a 10% loss, you think, well, that's the best one because it only takes an 11% gain to get back to even. But the problem with that is that, right away with the bid-ask spreads on most options, you could easily buy at the ask and sell at the bid and be near an 8 to 10% loss in a lot of cases, and that's just kind of the cost of doing the business of getting the leverage. And so we have to give ourselves enough room to let it wiggle around, but not too much room to let it go against us before we say uncle and move on. And so in that 25 to 33% range, if we drew in like the 33%, you can see it takes a 50% gain to get back on the next trade back up to where you were. After taking a 33% loss, you'll need a 50% gain to get it back to even. Well, I didn't write in 25% loss, but that takes a 33% gain to get back. So you can see that the gap between those numbers starts to widen from 10 to 11, that's 1 percentage point gap. 20 to 25, that's a 5 percentage point gap in absolute terms. 33 to 50, that's a 17 percentage point gap. Now, if you take a 50% loss, you're going to need a 100% gain to get back to even. That's a 50 percentage point gap. And, of course, anything worse than that is really disastrous in terms of, what it can do to your portfolio. So, and again, this is for looking at a whole portfolio. Any one trade, if you happen to get a bad gap against you for any reason, that's why we don't advocate putting too much of your risk capital into any one trade. Try to take multiple trades with smaller amounts of capital and spread yourself out among multiple opportunities. That'll also help you quite a bit to manage your risk. But this is just important to understand because it really does show you how you don't want to let your losers run. The other thing I've been talking about is this idea of a closing stop. If I'm using a daily chart, my biggest enemy is those intraday whipsaws. So what looks like a breakdown, and then it flips right back up by the close. So many years ago, I started using the idea of a closing stop, meaning that at the end of the bar, if I'm using a daily chart, it's the end of the day. If I'm using an hour, it's the end of the hourly bar. The end of that bar, when it closes, is when we get the confirmation, the uncle point of saying, okay, if it's violated that level, now I got to get out at the close. Or if it hasn't, if it takes some other traders out who are trailing their stops based on the prior bar's low, and then whips below there briefly, they get faked out. I know you've all had it happen to you at some point. I have too, where basically you get whipsawed, then it flips back up by the end of the day, and then boom, it's off the races, and you're on the sidelines. Well, we want to avoid that. So for me, on a daily chart, which is mainly the time frame we focus on here tonight, I say typically use the price 50 minutes or less into the end of the day's session. So, basically right near the end of the day, right near 4 o'clock, you're saying, okay, look, if the stop's going to get violated, then you can consider placing a market order or limit order just under the bid if you're concerned about the liquidity. In these cases, you shouldn't have too much of a concern with that because, the underlying currencies are fairly deep. But, basically that's how we tend to do things. If it's violated, get out, move on. Don't play the guessing game of, oh, well, I'll wait for it to bounce back in my favor. That's your ego talking. That gets you in a lot of trouble when you're trading.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.